Hi guys, this is Dan from the Investment ABC, and in this video I want to give you an update on my favorite company Nio. Furthermore, I want to discuss whether it is a good time to buy Nio at over $50 currently or not. I want to highlight the risks and chances for investors in this investment. I bought my first Nio shares back at the $3 range, and I was predicting that Nio would be a serious rival for Tesla in China, and that they would most likely reach a market cap of 100 billion US dollar in the coming years. Back at that time, the Tesla fanboys were laughing at me, but now Nio really has become a major player in China. Nio delivered 12,206 vehicles in the third quarter of 2020 compared to 4,799 vehicles in the third quarter of 2019. That is a 154% year-on-year increase in deliveries. Total revenues were 666.6 million US dollar in the third quarter of 2020, representing an increase of 146.4% from the third quarter of 2019 and an increase of 21.7% from the second quarter of 2020. Gross margin was positive 12.9% in the third quarter of 2020 compared with negative 12.1% in the third quarter of 2019 and 8.4% in the second quarter of 2020. Increasing positive gross margins is a good sign that Nio is on track to profitability. Who would have thought that Nio would improve its margin that fast? None of the analysts did a year ago. Nio's net loss was 154.2 million US dollar, a 58.5% decrease compared to the third quarter of 2019 and a decrease of 11% compared to the second quarter of 2020. Deliveries for October 2020 were 5,055, which points to a very strong fourth quarter. The company is expecting deliveries between 16,500 and 17,000 vehicles. On November 6, 2020, Nio launched the 100 kilowatt battery pack, which increases Nio's range even further. Nio launched the EC6 model end of July and deliveries began in September, so we will see how big the demand for this model will be. I'm expecting quite a high demand from customers. The EC6 will boost deliveries even further in the fourth quarter. In August 2020, Nio launched its battery as a service offer. This was a big catalyst for the current run-up in the share price. With battery as a service, Nio is separating the battery from the vehicle purchase. Consumers can buy Nio cars at a cheaper price upfront and pay for the battery and its services like upgrading the battery, for example, as part of a subscription model. With this strategy, you are able to remove barriers for a lot of people who can't afford the high upfront costs. Furthermore, you offer them a comfortable battery service which no other competitor is offering. So it seems like the consumers love Nio and its service when looking at the trend of car deliveries. It is not also the consumers but also investors who are pouring their money into Nio stock, but also other Chinese stocks in general. Ray Dalio is one of the most famous investors of our time, and he is very bullish on China and Chinese stocks, and even he invested in Nio recently. Thanks Ray for pumping the price. Nio had all this positive news which catapulted its stock price from $12 in July to currently over $55. Nio's market cap is currently more than 75 billion US dollar, which is bigger than BMW's, Daimler's and almost on par with VW's 78 billion US dollar. So let's compare the revenues of VW to that of Nio. VW had 59 billion in revenue for the third quarter 2020 compared to Nio's 666.6 million. I know that EV cars are most likely the future, but even if they are, how long will Nio take to achieve that kind of revenue and how profitable will it be at that time? The dimensions aren't right here in my opinion. At the current market cap, Nio is priced for perfection. It is not also priced in that Nio will dominate the Chinese market, but also a part of future possibilities like the robotaxi fleet with Mobileye or monetizing customer data. Analysts are estimating that Nio's 2020 revenue would be around 2.42 billion US dollar and that the revenue for 2021 would be around 4.54 billion US dollar. That would give us a price to sales ratio of 31 for 2020 and a price to sales ratio of 16.5 for 2021. What that means is that you are willing to spend $31 to get $1 in revenue. This is revenue and not profit. Other growing tech companies with better margins have a price to sales ratio of 8 to 10. Nio is until now mainly a car company. This could definitely change and might with a high probability, but still there is risk involved that something isn't going according to plan. Not only that the valuation is nosebleeding high currently, the upside for investors who are buying right now at these price levels are getting thinner and thinner, in my opinion. And the risk, on the other hand, higher and higher. You always have to compare the upside to the risk, in my opinion, and judge if the investment still makes sense. I love Nio as a company and I think and hope that they will do great in the future. But Nio as an investment doesn't look good to me anymore right now. That is the reason why I have sold out on my entire position and will take the money to deploy it in some still solid undervalued stocks with dividends and growth stocks which are still in the early stages with a lot of upside potential that not too many people know about or talk about. I have been a long time in the market to know that you shouldn't be emotionally attached to a stock, be it Apple, Tesla, or Nio. Just look at the risk reward of the stock and judge accordingly. I will go through some risks that concern me to have a big amount of money invested in Nio at this exclusive moment. I already said that the valuation metrics are getting at extreme levels, and in my opinion, the stock market just catapulted the stock price to a level that would be justified in maybe 5 years' time. At times, that happens when the hype is intensifying around the stock or sector. The stock price is shooting way over the intrinsic value, and at some point, it will trend back to it. The way to look at your stocks is the same way you should look when buying a whole company or running a whole company. If Nio would be my small company and generates me 1 million in revenue and say 100,000 in profits per year, but I'm expecting it to grow to maybe 10 million in revenue and 1 million in profits in the next 15 years, and a drunk guy would come along with a suitcase with $50 million in cash to buy the company on the spot, what would you do? I would take the 50 million right now, say thank you, retire, and deploy my money in income producing assets. It is just a small example because most people don't think like that. They don't care what the company does as long as the price keeps going up. Yes, the stock price could and most likely will go up even further, but to get out at the top is extremely difficult, and most of the time it is really hard to get out when reality sets in. The first drop could be 12%, and you think it is just a normal correction and think I'm not selling because I could have done it yesterday 12% higher. The price will go back up like it always does. The next day it goes up 4% and you're relieved. One day after, the stock price drops another 10% and keeps falling and falling, so you get the point. I like Warren Buffett's quote, Mr. Market is kind of a drunken psycho. Some days he gets very enthused, some days he gets very depressed, and when he gets really enthused, you sell to him, and if he gets depressed, you buy from him. There is no moral taint attached to that. The EV market is clearly in a bubble right now. I have been saying it a couple of months ago, but I also said that I'm expecting it to continue even further. At that time, we were at the beginning of a bubble, but right now we are at the late stages of that bubble, and it won't take much to pop it, in my opinion. Just look at the gains in the EV space in the last few days, where some companies were up almost 50%. Don't understand me wrong, I can't look into the future and tell you exactly when the bubble will pop. Maybe Nio will run up to $100 by the end of this year. No one really knows. Bubbles are fueled by cheap money and greed. We are at the stage where you see your friends and family members talking about how they made $10,000 yesterday, and the other one said like, hey, I'm at 15,000, and now you're thinking about buying your first shares. You ask your friends, what is a good buy? Which stock should I buy? And they recommend you Nio. Then you ask YouTube, and the majority is saying Bye Nio. So obviously, what you're gonna do is you go and buy Nio. Just be careful when you listen to YouTubers in general. Don't listen to any of them, not me or any other person, and always do your own due diligence. In the case of Nio, Tesla, or other hype stocks, they recommended to buy it and put price targets of $300 or more because that is how they grow their channels. You give the masses what the masses want to hear. So just understand that point and do your own due diligence. Another reason why I said bye bye to Nio is that the global economy is still very fragile and the worst is yet most likely to come. This current run up in stocks from the March lows is due to the increase of the Fed's balance sheet and stimulus programs. The effect of these unprecedented actions will run out soon. We have to see if another stimulus program is coming or not and how big it is going to be. Longer term bear markets start when the retail participation increases. This happened just this year at an accelerated level. When the global economy tanks, Nio and many other car companies will suffer too. If the growth of Nio just slows down by a little bit, the momentum and sentiment could change quite fast. Suddenly, the balance sheet and cash will be important to the market. A weakness in the global economy at a time where competition in the Chinese market intensifies could be very risky for not only Nio but many car companies in general. Nio has competition from Tesla, XPeng, BYD, and will also get increasing competition from the traditional car companies like Daimler, BMW, or VW. When the global economy is weak, these companies will try everything to get rid of their cars and margins decrease. Another risk is that the Chinese government could reduce or remove the subsidies for EV cars, which could hurt all EV companies, including Nio. The last risk is that investing a large amount into an American depository receipt, also called ADR, is something I can't justify at the moment. For those of you who don't know what an ADR is, check out my video where I talked about it and explained the difference between the two OTC tickers BYDDF and BYDDY of BYD. The danger of delisting Chinese companies from US exchanges is a possibility. We don't know 100% how the US-China relationship develops under Biden as president, and we could also see that despite everything, Trump will be the president. Most of the risks were always there and I didn't care because the risk-reward ratio was still good. But now I'm not willing to take the risk anymore. I just tell you guys what I'm personally doing. I'm no basher or a China hater like some other people. It is just that I think it is the best time for me to move on. So this is no financial advice. I'm no financial advisor. So always do your own due diligence, guys. Normally, I would say now, if you liked the video, hit the thumbs up button to support the channel, subscribe for stock picks with growth potential, comment and share the video. This time I say you are allowed to smash the dislike button as hard as you can. Bye guys and see you in the next one.